Do you want to learn trading as a profession, not just a hobby or a gamble? Dr. Alexander Elder's famous book, Trading for a Living, is a masterclass that teaches you how a successful trader thinks, plans, and acts. In this book, Elder says that successful trading is based on three main pillars: mind, method, and money. Until these three things are balanced, survival in the market is just a dream. In this video, you will learn how to create a solid trading plan, how to strengthen your trading psychology, and how to use money management as your greatest strength. So if you want to adopt trading as a real profession, you must watch this video until the end. Let's enter that trading room with Dr. Elder, where professional traders are made. Chapter 1, Part 1. You cannot understand the market until you understand yourself. Jumping into the stock market is like getting lost in an unknown jungle without a map. And if you don't prepare yourself, this jungle can swallow you. Most people come into this arena only for the greed of making money, but they forget that the real game is not about money, but about mentality and discipline. Trading is actually a profession, and like any profession, it requires deep understanding, hard work, and the right strategy to become proficient. Many people think that trading means buying low and selling high, but this idea is incomplete. The market is not just a game of numbers, it is a mental game where your emotions are tested at every step. How patient you are, how quickly you can make decisions, and how many times you can control yourself determines whether you will be a successful trader. The author says that if you want to be a doctor or an engineer, you have to study and practice for years. So why do people bet millions of rupees on trading without any preparation? He considers this a form of negligence and says it is essential to change it. We can start with a trading diary. The purpose of the diary is not just to keep a record of profits and losses, but to be a medium for recording your thoughts, your emotions, and your decision-making process. This diary will help you understand why you took a particular trade, what your mental state was at that moment, and what the result of that decision was. When you read your own mentality over weeks and months, you will start to catch the hidden patterns within yourself, and this is where real improvement begins.
Now let's talk about a very important topic: time management. Trading works like a full-time job even if you were doing it part-time. You have to dedicate a specific part of your day to trading only. Research, planning, and a quiet place for trading where no one will disturb you. A computer, a good internet connection, and charting software, these are your tools. But even more important than these tools is a calm and focused mind. You have to honestly ask yourself, do I completely analyze my trades? Do I have a trading plan, or am I just guessing? The next thing is market selection. Watch the behavior of the market you want to trade in every day. Note the trends, and know when and why changes occur there. Then comes time frame selection. Many new traders constantly change charts, sometimes 5 minutes, sometimes 15 minutes, sometimes daily. But by doing this, they only get confused. You have to choose a time frame that matches your lifestyle and mentality. If you can give all day, intraday trading is fine. Otherwise, daily or weekly time frames are better. Remember, you cannot adjust yourself to the market. You have to create the right system according to your habits. Now let's talk about a concept that is the backbone of every successful trader: risk management. If you think about winning every day in trading, first learn how to avoid losses. A good trader first determines how much money he is ready to lose in a trade, and if the risk is more than that limit, he does not take that trade. Many people invest so much money in a trade that if it turns out to be wrong, their entire account is wiped out. This should not be done. Position sizing is very important for risk management. This means that how many units you are buying in a trade depends on your account size and stop loss. Suppose you have 1 lakh rupees and you want to risk only 1%, that is 1,000 rupees in a trade, and the stop loss of that trade is 20 rupees per unit. Then you will buy only 50 units. This formula is as simple as it is important. Now let's talk about emotions. The biggest enemy in trading is not the market, nor your strategy, but your fear, greed, and haste. When a trade is going well, greed says, wait a little longer, you'll get more profit. And when there's a loss, fear says, sell it now, everything will be gone. Coming out of this mentality is becoming professional. This requires a set of trading rules. The author says that every trader should follow his own rules. For example, when to enter, where to set a stop loss, and when to take profits. These rules are your shield of protection, which saves you from unnecessary risks.
After daily trading, you should do a post-market review, i.e., look at all the trades of the day and understand where you were right and where you were wrong. This process will make you better every week. Many people think that they will become rich just by getting a good strategy, but the truth is, there are hundreds of strategies. The one that works is the one that is applied with discipline. And finally, the author introduces us to a reality. As long as you understand yourself better, you will understand the market as well. Chapter 1, Part 2. Now let's talk about another important aspect that people often ignore, and that is mental preparation for trading. When you enter the market, your mind is your biggest tool, but if that mind is not prepared, it can also be your biggest weakness. Every day when you come to your trading room, you should ask yourself some questions. Am I influenced by emotions today? Am I still carrying the burden of yesterday's loss? Am I too excited about new trades today? These questions are important because if you don't trade with a clear mindset, you will keep making the same mistakes. The trading field is very noisy. News, rumors, others' opinions, and sudden price fluctuations. In such a situation, if your mind is not calm, you will start dancing to the tunes of others. And this is where mental focus is needed. The author says that a successful trader is one who can think alone even in a crowd. This means that you will trade according to your system and rules, even if the world says otherwise. Now let's talk about another deeper aspect of the trading journal. It is not enough to just write what you bought, at what price you bought it, and at what price you sold it. The real journal is created when you write in it why you took that trade, what were your thoughts at that moment, and what was the emotion behind that decision. Fear, greed, confidence, or just a guess? This level of honesty awakens the power of self-observation in you, and this is where professional improvement begins. Now let's come to another big factor, overtrading. This is a trap that 90% of new traders fall into. Sitting in the market all day, reacting to every fluctuation, and always trading something indicates that you are not trading, but are on the path of addiction. The author says that the best trades are the ones you don't take. This means that patience is as important as skill. To avoid overtrading, set a limit on the maximum number of trades per day. If you plan to do 2 or 3 trades a day and they are completed, then turn off the computer. The market will open tomorrow, but your mental energy is limited. Every trade consumes your attention and emotions, so use it wisely. Then comes an extremely deep and important topic, money management. Many people think that trading is about the right entry and the right exit, but they forget that the real magic is hidden in money management. How much capital you invest in a trade, how you control risk, and how you increase your profit, that determines whether you are still trading in the next year. Here it is very important to understand a rule. The 1% risk rule. This means, in any one trade, only risk 1% of your entire account. If you start with 1 lakh rupees, you should not tolerate a loss of more than 1,000 rupees in a trade. This rule will help you to survive for a long time, even if you lose 5 to 6 trades continuously. Now, let's talk about a practical matter, keeping records.
The author repeatedly emphasizes that you should take a screenshot of every trade, write down every decision, and review it every week. This habit may seem boring to many people, but it doubles your learning speed. You can understand where you took trades unnecessarily, where you were in a hurry, and where your plan worked correctly. This is a mirror that shows you the reality, and that reality improves you. Along with this, a professional trader should also take care of their health and energy. Not getting enough sleep, trading in a tired state, or sitting in front of the computer on an empty stomach, all these things affect your decision-making ability. Remember, you're not a machine. Your physical and mental condition determines the quality of your trading. So make good sleep, proper diet, and a little exercise a part of your trading habit. Another concept, which is very important, is the learning attitude. The market is always changing. New trends, new news, new situations. So a trader has to keep learning all the time. This means reading books, participating in webinars, following other professionals, and most importantly, continuing to question yourself. What did I learn today? What mistake should not be repeated? Am I satisfied with my process? Through these types of questions, you can improve yourself every day. And finally, it comes to long-term thinking. Many people think that they will become rich from trading in a few months. But the author repeatedly says that trading is a marathon, not a sprint. This means that you have to slowly strengthen your skills, celebrate small victories, and see every fall as a learning opportunity.
This is the real meaning of trading, constantly getting better, accepting your mistakes, and surviving in this field with a strong professional attitude. When you completely dedicate yourself to this process, the market gives you what you truly hope for. Chapter 2, Part 1. If you consider trading a game, believe me, this game will play with you. Whenever we adopt a profession, such as a doctor, lawyer, or pilot, we first have to go through a training process. But trading is an exceptional profession where most people jump into the field without any training. And this is where the journey of destruction begins. The author teaches us that if you really want success in this field, you have to see yourself as a student. You have to be ready to learn something every day. Chapter 2 introduces us to the first real step of the journey of becoming a trader: self-assessment. Have you ever truly asked yourself this question: am I ready for this profession? The answer to this question is not found only from emotion or greed. The answer is hidden in your habits, your thoughts, and your mental stability. Trading is not a thrilling roller coaster. It is a meditation, where you have to pay a price for every wrong step. The author says that it is important to do a profile test before starting trading. For example, do you get excited quickly? Do you delay admitting your mistakes? Are you afraid of taking risks, or are you too excited about it? The answers to all these questions determine your trading style. If you assess yourself carefully, you will know whether you are good for swing trading or day trading or long-term investment. Now let's talk about the three main pillars of trading, which the author calls the three-pillar system: mind, method, and money. The first pillar is mind, that is, your mentality. If your mentality is not stable, then even if you have the world's best trading strategy, you will lose. A good trader knows that he has to control emotions at any cost. If you make decisions influenced by fear, greed, regret, or anxiety, then you have gone a long way from any logic. The job of the mind is to stick to the rules, no matter how volatile the situation is. The second pillar is method, that is, your trading method. This means a system where you know when to enter, when to exit, and on what basis to make decisions. This system can be anything: technical analysis, chart patterns, indicators, or price action. But that system will work only when it has been tested repeatedly and is compatible with your nature.
It's just like a surgeon becomes proficient in his tools. He knows which instrument to use when and how. And the third pillar is money. That is, money and its management. This is the part that is most often ignored.
People consider trading a way to make money, but they don't understand that money itself is a resource that has to be managed. If you try to become rich all at once by investing a large amount in every trade, then you are trading like gambling. Money management means trading with small, controlled risks so that you can survive for a long time. If your mentality is stable, your strategy is strong, and money management is powerful, then will you not be successful? These three pillars take you to that professional level where very few people can reach. Now let's talk about trading education, that is, the process of constantly learning. According to the author, the market is not anyone's guru. It is only a test. The real education we get from our records, from our mistakes, and from our attempts to improve. But a problem comes here: overconfidence. Whenever some people make a profit in 3 to 4 trades continuously, they start to consider themselves experts. They start breaking the rules, taking more risks, and thinking that now the market is in their hands, and then that market brings them down to the ground. The author warns, whenever you feel that you have now understood the market, then understand that you are in danger. Learning and trading never ends. Every time the market shows a new form, we have to read it again. And if you think that once you have learned everything, believe me, you are doing the biggest deception to yourself. So the author reminds us again of humility. Humility is the quality that allows us to learn. It teaches us to accept that we are human, we will make mistakes, and every mistake is an opportunity to improve, to move forward. With this, the first part of the chapter ends here. Next time, we will learn how to create a strong trading system and which fundamental technical tools every trader should understand. Chapter 2, Part 2. So, now let's talk about the foundation on which the entire building of trading stands. That is, the need for a strong and clear trading system. Most new traders make a big mistake. They start trading without any specific rules. Sometimes they are influenced by some social media post, sometimes by a tip-giving channel, and sometimes just by the fear of missing out on the opportunity. But the truth is, if you don't have a reliable system, you are shooting arrows in the dark. A good trading system answers 4 questions: when to enter a trade, when to exit, how much money to invest, and when to stop if there is a loss. The author says that no system is perfect. Every system will have a loss at some point, but the difference is that a good system keeps the losses small and lets the profits grow big. This does not mean that once you create a system, you will never change it. You have to test the system from time to time, backtest it, and see how effective it is in today's market. Now let's talk about some basic but powerful technical tools used in trading. The first and most popular is the moving average. The moving average is a simple indicator that shows the average price of a stock for the last few days. When the price is above the moving average, there is usually an uptrend, and when it is below, there is a downtrend. This is a powerful tool. Another important tool is volume. It shows how many units have been traded in a specific time. It works like a driving force. If the volume also increases with the price, then that movement is strong. The third tool is RSI, that is, Relative Strength Index. It tells whether a stock is overbought, excessively bought, or oversold, excessively sold. From this, it can be guessed whether there can be a change in the price. The purpose of these tools is not that they will give you 100% correct trades. Their purpose is to strengthen your understanding so that you can make better decisions. When these indicators align with each other, they take your trading to a scientific foundation. The author also introduces us to an extremely important topic, the psychological cycle of trading. Every trader goes through 3 emotional stages: hope, fear, and regret. When we start a trade, we have hope that this trade will be successful. As soon as the trade starts going a little wrong, fear surrounds us. And if we exit in a loss, regret does not leave us. This cycle continues until we learn to recognize and control it. The author teaches that when you believe in your trading system and stick to it, you can escape this emotional trap. Fear and regret come when you make decisions without knowing or thinking.
But if you have a pre-made plan where entry, stop loss, and target are clearly defined, then emotions cannot influence your decisions. Along with this, it is important for us to understand that every trade has no value in trading, but the result of the long run is important. The author explains this with the game of coin toss. Suppose you have a coin that comes up heads 60% of the time and tails 40% of the time. If it comes up heads, you get 2 rupees, but if it comes up tails, you only lose 1 rupee. Then comes another very important topic, the mathematics of position sizing. The author explains to us that how much to invest in a trade is much more important than what to buy. Many people invest their entire capital in one trade. There is only one way to avoid this. In every trade, determine in advance that if it is wrong, how much loss can I bear? And then, on that basis, choose your position size. A simple rule is that you can risk only 1% of your account.
These rules, discipline, and habits of trading create a professional. Waking up at a specific time in the morning, preparing before the market starts, reviewing the charts, updating your trading journal. All these small things make your big decisions easier. Trading is not a miracle. It is a lifestyle. And in this lifestyle, you have to bring your thoughts, your behavior, and your plans into practice with complete honesty. When these things become a habit, trading becomes not a burden, but a means of joy. And finally, the author gives us an excellent suggestion. If you consider the chart only a graph, then you do not understand the language that the market is telling you. Technical analysis in trading does exactly what a doctor's stethoscope does. But many new traders use it only as a decorative tool. They see the chart but do not read it. In this chapter, the author teaches us the art of reading charts so that we can understand the movements of the market in advance. First, understand that technical analysis is not a prophecy. It is not magic that tells you what will happen tomorrow. Its purpose is to identify possibilities and make smart decisions based on that information. The charts show us how the crowd is thinking, how it is reacting, and where there is a possibility of change. Here the author says a very simple but powerful rule, that is, as long as the trend is going on, it is your friend. As soon as it breaks, be careful. Many people consider a small retracement to be a trend change and trade in the opposite direction. But understanding and following a trend is one of the most powerful strategies in trading. Now let's talk about how to identify a trend. There are 3 main trends: uptrend, downtrend, and sideways. In an uptrend, each subsequent high is higher than the previous one, and each subsequent low is above the previous one. In a downtrend, each subsequent low is below the previous low, and each subsequent high is lower than the previous one. In a sideways market, the prices fluctuate within a specific range. It neither goes up nor down. Identifying a trend is so easy, but following it is just as difficult, because emotions come in between. The author teaches us that for understanding a trend, the correct use of time frame is essential. If you trade on a daily chart, you should also look at the weekly chart so that the big trend can be understood. Focusing too much on small time frames often creates confusion. It is like looking at every word with a microscope while reading a book. You will never understand the story. Now let's come to chart patterns. These are the formations that are repeatedly created in the market and give us a signal about which direction the next move can be. For example, the head and shoulders pattern is a very classic reversal pattern, which indicates that the trend is likely to change. On the other hand, patterns like triangle, flag, and double tops prepare us for a breakout.
Also, volume plays a very important role. If the price is going up but the volume is weak, then this movement may not be sustainable. On the other hand, if there is a rapid movement in the price and there is also a huge volume with it, then understand that the market is serious. Now let's talk about indicators. Many people think that if they put RSI, MACD, Bollinger Bands, stochastic all together on the chart, they will get a super system, but it does not happen. More indicators mean creating more confusion. According to the author, it is better to make fewer but prudent decisions. Every indicator has a specific purpose. RSI shows overbought and oversold. MACD determines the strength and direction of the trend. Bollinger Bands show volatility. But if you use these three indicators together with understanding, your system can become more powerful. The author also says that no indicator is perfect. Every tool gives a guess, not a guarantee. So it is important that we use the indicator as a confirmation tool, not with the help of a signal. For example, if the price is in an uptrend, RSI is above 70, and MACD gives a positive crossover, then the logic for entering the trade becomes more strong. Now, an important question: when to enter? The author says that the best time to enter a trend is after a retracement. When the market is going up or down and it pulls back a little, that is the right time, because there the risk is less and the profit is more. Many people enter when the price has gone too far and then the stop loss hits quickly. At the end of this part, the author makes us understand a simple but extraordinary thing. You do not need a telescope to see the market, but you need a clear vision. Technical analysis, charts, and indicators, all these are profitable only when you look at them from a complete perspective. Otherwise, these are just bright illusions that can lead you astray.
Suppose your system has three conditions. First, the price is above the 14-day moving average. Second, the RSI is above 70. Third, the MACD gives a positive crossover. If all three signals match, you will take the trade. Otherwise, you will stay put. There is no complexity here, but consistently following this simplicity can make you a master. Let's now talk about an extremely important aspect: stop loss. This is the word that most traders hate because it means accepting defeat. But the truth is, a trader who doesn't respect a stop loss cannot survive for long. The author says the stop loss is your last wall of protection. And this is true. A small loss can save you from a big one. The best way to set a stop loss is to base it on some technical foundation, such as a previous swing low, a support level, or a moving average. Never set it arbitrarily, like putting a stop loss of 500 rupees because you don't want a bigger loss. Thinking this way, you are not deceiving the market, but yourself. The author also highlights an interesting point. The science and psychology of trading go hand in hand. If you don't set a stop loss at the time of entry, fear and greed will play a game of tag in your mind while the trade is running. But if you have planned everything in advance, your mind will remain calm, and you can make decisions based on logic. Next comes the art of exiting a trade. Many people panic as soon as they make a profit and exit immediately. Others delay in the hope of increasing their profit, and then the profit they had disappears. So where is the right exit? The author answers this very precisely. The exit is where your system tells you, not your emotions. That is, if you have predefined a trailing stop loss or a target, then only act on that. If the trade moves in your favor, slowly move the trailing stop loss upwards. This way, you protect your profit and keep the trade open.
Now, let's talk about something that is very close to every trader's heart: false breakouts. This is when the market looks like a big move is coming, but then suddenly reverses direction. This happens when people jump into a trade without any confirmation. The author gives an important rule here: trade the breakout, but only when it is supported by volume. That is, if a stock breaks a range and the volume is much higher than average, only then is that breakout considered real. Also, waiting for a retest is a good strategy to avoid false breakouts. When the price breaks a resistance and then returns to that same level and makes it a support, it is safer to enter there. This is called trading with confirmation. The author also emphasizes another point: don't trade the news, trade the chart. That is, never trade based on news, because by the time the news reaches the general public, smart money has already built their positions. Charts give a signal first, and news comes later.
So, technical analysis keeps you away from emotion and helps you make decisions based on information. Now let's come to the importance of a trading diary. This diary is not just a simple notebook. It strengthens your entire mindset, your thoughts, your emotional state, and your decision-making ability. Self-observation increases, and most importantly, you start to avoid your own mistakes. The author calls this the blueprint for improvement. And the main point of this entire chapter is that technical analysis is not a trick or magic. It is a science that leads to success only by learning it, applying it with discipline, and sharpening it with your own experience. Every chart, every line, every pattern tells a new story. The only difference is, are you ready to listen to that story?
Real victory in trading comes when you manage your money like a soldier manages his weapons with discipline, caution, and wisdom. Many people think that having the right strategy is enough, but the author reminds us that if the right strategy is not accompanied by money management, your victory will not last. Money management is that silently working part of trading that keeps you alive when everything else goes haywire. This chapter starts with the most important principle: preserve your capital. That is, in any situation, the first thing is to save your own money, because when the capital is gone, there is no question of returning. So no matter how attractive a trade seems, if it involves a very big risk, it is wise to say no to it. Now let's talk about the question that comes to every trader's mind first. How much money should I invest in a trade? The author teaches us a principle called fixed fractional position sizing. This means that in every trade, you will only risk a specific percentage of your total account. Most experienced traders risk 1% or less. For example, if you have a capital of 1 lakh rupees and you want to risk 1%, you cannot lose more than 1000 rupees in any trade. This doesn't mean you will only trade for 1000 rupees, but rather you will put a stop loss on that trade in such a way that even if it is hit, the maximum loss will be 1000 rupees. Now there is another aspect here: risk to reward ratio. The author says that before every trade, you should determine whether there is a possibility of earning at least 2 or 3 rupees in return if you are risking 1 rupee. This is called a 1:2 or 1:3 ratio. What this does is that even if you win only 4 out of 10 trades, you will still be in profit. But sometimes people set very far targets for a good RR, which are never hit. So the author advises keeping the targets realistic. That is, don't be too greedy and don't book profits too early.